Hey everyone, welcome to another Groundhog Day in July. So, oh my gosh, who would have thought we were still going to be talking about this in July? You know, I think Groundhog Day was in like February 2nd or something, or 22nd, something like that. I don't remember. It's in February. Anyway, so just a reminder to anybody crazy enough to join us again today, use the Q&A to ask your questions, use the chat to harass us. And I know that we've got a few things. First of all, one thing that I do want to say is I got a note yesterday from Brian Red at Pinnacle Bank, and they have opened up the gates again to accept applications for PPP. As we talked about last week, there's 130 million bucks or billion, 130 billion that's still available. And the problem is a lot of banks were saying, no thanks, but they have opened up the gates again up until the deadline of August 8th. So that's late breaking news as of last night. So just make a note of that. So, and I know we've got a couple questions that have already come in, and we'll deal with those. One of them in particular for Brent with EIDL. Adam, any thoughts on the preamble, and then we'll kick it over to Jack, and then we'll dive into questions?
Yeah, I haven't had a whole lot of new types of questions that have come up in the last couple weeks. I mean, generally it's all around, am I automatically 24 weeks, or am I 8 weeks, or when can I apply for forgiveness? So not much new on my end. How about you, Jack?
I had to hit unmute. So same thing. I can throw out a couple of statistics. There was a Wall Street Journal article that came out a couple days ago, and it has the numbers that we know about. 130 billion of the 670 billion set aside remains unclaimed, which is a surprise because within the first 2 weeks, the first 350 billion got eaten up pretty quickly. 170,000 loans totaling 38.5 billion have been canceled as of May 31st. I think those are the ones that said, maybe I didn't really need that and I don't want to get in trouble. So that's my speculation on that. We know about the changes and other things. One thing that I thought was interesting was there have been questions, not to me, but I guess in the general public, about that if you received a PPP loan and gave the money back because your business wasn't ready to open, can you apply again? And apparently the Treasury is saying no, that if you applied for a loan and gave the money back, that they considering that loan paid off, and it's a 1-for-1. So you got it, you gave it back, and you're done. I don't know if that's the end of that story or not, based on what might happen down the road, because again, things have changed. The goal is to help people and not penalize them. And the fact that they were not taking the money when they didn't see necessarily a need for it. They knew they needed it, but they couldn't justify it at the time because they weren't open. I think hopefully there will be some more grace extended to those people that were honest with themselves, that they weren't going to just take the money without having I shouldn't say legitimate, but an immediate need for that money. At some point, I don't know, Gary, I have those slides that I sent to you that have the PPP report from June 30th. So if we have time, maybe at the end, and there's some interest, we can kind of go through those statistics if you want to. But
cool. Yeah, what I would say is if you want, go ahead and get that up on your computer, and then I can share screen and let you do that, because it'll be faster than me finding what you sent me. So one thing that I think that would be beneficial too, I had a couple in the last week since our last webinar, sole proprietors or people that were LLCs with just 1099s. And one in particular is getting moved over to be taxed as an S Corp this year, but last year they were still LLC, and they thought that they were not eligible for PPP. So I thought that might be something worth just kind of bringing back up some of the talking points from a sole proprietor standpoint. But I do have one question, if it's okay with you. I told Brent, I talked to him on Monday, and here's the scenario. So this is on EIDL. He says, I was approved for an EIDL loan, have 30 days, probably a dozen left now, to decide whether to take the loan. Terms are 30 years, 3.75% with deferred payments like they were supposed to be. My concern is in reading the contract that is required to be signed that says things I don't feel very comfortable with. So this, Jack, gets into some of your fine print known in your industry. Things like my financials need to be turned in every year, and they can request that they be audited at my expense whenever they want. Also, that no assets of the company can be sold without written permission of the SBA. That basically is my whole life, and existence is now used to secure this loan. That if I determined that I didn't use the funds in the way that they were intended or they see fit, I could be fined an amount 2 to 3 times the original loan amount. These are things that are in there that also concern me. I've not signed because of these concerns. Am I right to feel like I don't want the loan after reading these terms? Does anyone else have any experience with this that says it's not as strict as and intrusive as the contract appears to be? Thanks for your help.
I guess that falls on me first. So I would say that, and I don't say this flippantly, but you know, it's kind of like the one with the money makes the rules, essentially. And so this is the rules that they've put together. They are going to be as harsh as you've said they are in order to protect them, the lenders. I have not personally, I've had clients and others who have said, yeah, this seems very onerous on us and in some cases unfair. And it's essentially non-negotiable. So, you know, and that wasn't the question, you know, can we change it, negotiate it, but essentially it's non-negotiable. What I would say is that it's one of those situations where, you know, they put those things in place for the people that are blatant offenders and that are you know, either now know in this moment when they accept those loan funds that they are not going to be able to comply with the spirit of, or have no intention of complying with the spirit of that, hoping that they don't get caught. Others are in the category of, well, I'm going to do my best efforts, and it may become an interpretation of proper use of those funds, my interpretation versus theirs. And so it goes back to comments that we've all said in previous seminars or discussions that, you know, really these things are tailored to find the bad people with bad intentions and is not meant to penalize good people with good intentions that may have done things that were not quite within the parameters of what they were supposed to do. And again, that's subject to interpretation. So I'm not really answering your question of, you know, making you feel good or bad or better about it, but other than to say that, you know, it's yes, those things that you said, Gary, are accurate in a sense that the things that they could do under certain circumstances and under certain interpretations. But if you look at a lot of, you know, I've looked at a lot of loan documents and loan covenants that seem oppressive and onerous, but that's just the way they are because they're there to protect against the bad people. There's always judgment that is intervened by the lender, essentially, as far as, you know, was this an innocent mistake, and is there a way around that? And sometimes it is a slap on the wrist where they will say, well, okay, we'll waive the penalty, but you need to pay interest because, you know, you owed us money and you're kind of using our money. So there are ways to soften the blow, even if there is an inadvertent misuse or misalignment of following the rules, if that makes sense.
Yeah, reading that, some of those things that were included in there made me think of any of the legalese on any drug commercials. If you use whatever, it could cause this, and death. But like, well, why would I take it?
Exactly. Yeah. I mean, yes, absolutely. And they say it very fast or in fine print. And it's like, why would you ever put your body through something like that? And it's because, well, there is a benefit to it. There are risks. So yes.
Any thoughts from your standpoint, Adam, or
Yeah, the language itself is, I'd echo Jack's comments. The language itself is actually not that far different than what you'd read buried in a typical loan document. So it's not too surprising. I mean, if you just follow the logic in this particular one, it's like, look, they're looking to be secured by something, and secured by something means the assets of the business. So what do they not want to have happen is you selling off all the assets and winding down, because they're now a priority creditor for you. So it's somewhat not surprising. All that said, again, I'm not advising anybody to take a risk they're uncomfortable with. So just a data point, we have a lot of clients that have obtained SBA loans prior to this, and we ourselves had an SBA loan for a while for one of the practices that we acquired. And the number of times that I've heard of anybody from the government asking a question subsequent to the loan approval is that. So don't know if you have a different experience, Jack, but I mean, it really, it is some harsh language. Is it materially different from what you read in another loan document? Not substantially. But I mean, I think even like credit card documents say that, hey, if you buy something with a credit card, you can't sell it or something like that. So it's not too crazy. And at the same time, I've never heard of the SBA asking a question after the loan was made. So I think while the impact of the SBA coming in could be devastating, I think the likelihood that it would actually occur is pretty darn small.
I would agree with that, and with a caveat that you've put everything in the right order, filled it out properly, and you don't have a grumpy employee that goes and tells on you, even if you didn't do something bad, that you end up in an audit mode.
So this is going to put either one of you a little bit on the spot, and if you don't want to answer it right away, that's fine. You can beg for some time, but I would like you guys to weigh in on just some of the highlights for if somebody's a sole prop and they discounted for one reason or another, the ability or need or even I guess viability of being able to apply for a PPP loan as a sole proprietor. And now all of a sudden, okay, the deadline has been moved from June 30th to August the 8th to apply. There's still money out there. Any thoughts or points that you guys would want to drive on that?
No. I would say just one thing on that is that, there is a look back period. So I read something that makes sense. That is, if, you as a sole proprietor or a single member LLC took a loss last year, and, you're using that as the basis, that there might be some difficulty in saying, okay, and this is what I should get because I don't have the numerics to justify that. And so, but, I would say so long as, if you've come to the revelation over the course of time that, okay, yeah, you're in the possible participants, then I would go ahead and do it. I mean, you can go ahead and turn it down later, but get into the mix of things and get into the process if you're not already in the mix of things, would be my suggestion.
Yeah, I'm in the same boat as Jack. I don't see a downside. And again, this is the just the realist in me is that we're all going to be paying it back anyway at some point in the future. So it's good taxpayer. Might as well take the money that you're otherwise going to be paying back at some point in the future. So.
All right, cool. So we have got 53 people that have still joined us without the tyranny of the urgent crashing upon us. So that's still interesting to me that there's still questions going on out there. So I'm going to go ahead and rock through some of these questions. I'm going to start actually with a scenario, and this is from David, and then I'll get to the questions. So the scenario is this: an employee quit or was laid off prior to the company receiving the PPP loan. Then the company received the loan, paid the person a small severance payment during the covered period. When using table 1, if you use the severance money, it will trigger a large penalty based on underpaying that individual. Simply not report that individual's wages, or is there some other method? So that's a question dealing with that. And let me continue on here. It says, how should we record the facts on table 1, schedule A, if an individual employee falls into one of the exemptions, such as was offered to restore the job, but declined or quit or asked for fewer hours?
Well, I mean, you've really got a couple moving parts there. On table 1, you're in, like, when you think about what am I reporting, I'm reporting people that I've actually paid. And so in this case, you've used the money, but one of the people that you used the money for, or on the basis of the calculation, is no longer there, and you're not replacing the job. As long as you're, I don't, you're just attesting to the exception. So I don't see where this person would have to be reported if they were pre part of you receiving funding, but were the basis of the amount that you got, because either you spent the money on somebody else because you're on the 24-week window and just can spend more, or you just spend it in 8 weeks, or somewhere in that intervening time period, if I heard the question correctly.
Yeah, the interesting part to this story was they quit or were laid off prior to the company receiving the loan. So they were probably part of the basis for the calculation for the application. But then the company received the loan, paid the person a small severance payment during the covered period. And if you include the severance money, it triggers a large penalty based on underpaying that individual. And he's like, can we not report that individual's wages, or is there some other method?
Well, I don't think you can not report it, because it's going to be part of your payroll documentation. So it's already factored in there. In this case, I think if you just look at it, the person left, so the annualized basis of them being there for 1 day, you're probably still fine. I see David's trying to provide some clarification. So I think because the amount paid in the severance doesn't span the entirety of the time period, the math would say I think you'd be fine, having not having shown the 75% reduction.
And my first comment is, I feel like David is like the 8th graders that I teach, and I encourage them to try to challenge the pastor, and so that and the pastor always has the answers. And I can't say that we will always have the answers, but I appreciate the challenge and the questions. I would say, really, it sounds like we're talking about money that was received and used, and if you put that number in and seek forgiveness, or you using that money for that purpose, then there's a penalty. So maybe the solution is using your other operating capital and allocated that to the severance payment and not even mix it into, I mean, because it's, or, and put, if you're keeping the money separate, fill that hole that you created from of the severance amount in the PPP loan account, funds account, put that back in and just, so reclassify that. And so that doesn't necessarily fix all of the reporting issues, but that kind of maybe fixes the perception of what funds you're using for that.
Yeah, I mean, if you think about like what your reporting is going to look like, I mean, going back to, I think David had shown a comment about the annualization, that might, I don't want to have it as a misnomer, but if you just think about what it's going to show, paid the person $5,000, I'm making this up, number of weeks worked in the quarter, because you're presumably providing a quarterly payroll report, 1 week, $5,000 for 1 week, did they make over $15,300? Answer is no, they only made $5,000. They only worked for 1 week, thus their pay wasn't actually reduced. When you think about it in terms of the total body that they would have worked. So I think, whether you excluded it or you reported it, I think you'd be fine just based on the duration of the time that the person worked, which was really nothing because it was a severance payment.
So in the chat, he added one other thing. The form asks for the total gross wages paid during covered period. It doesn't have a spot for annualization or duration.
Yeah, but in this case, it's not, you only paid the severance period. You only paid the severance amount. So you didn't reduce them because they're no longer there.
All right, well, I'm going to move on to the next question. Hopefully, David, that answered, and if not, you know where to find us.
Yeah.
This is from Ann. An employee left voluntarily. Is the correct place to account for this to add her back in the FTE reduction exceptions above box 2 in table 1? We don't qualify for safe harbor 1 or 2, so wasn't sure if this is where to account for it.
Yeah, I mean, so the person left voluntarily. You haven't replaced the position. I'm assuming in this case. So you'd have to basically document that you've made your best effort to either replace the position, or alternatively, you're not replacing the position because of a disruption. That not having the form in front of me, that's basically the route that you would try to go for, is that I can't replace it because I can't find anybody to take the job. Or alternatively, I don't need the job anymore because of reduction.
Okay, thanks, Ann, for this additional info on the chat. Technically, she went to part-time, but really hasn't recorded hours.
Well, I mean, then that's effectively gone for this purpose. So.
Okay, next question is from Judy. A small business owner asked me this question yesterday, and I didn't know how to answer. He was approved for an $11,000 PPP loan for his one-man firm. He's now dissolving that company, but has not yet submitted forgiveness application. Will he still be eligible for forgiveness if the company is no longer in business?
Yeah, these are stump the pastors.
Man, these are good questions.
Yeah, I mean, I feel like you got to have, like, unless you can demonstrate a merger or an assignment, I mean, I feel like you got to get the forgiveness before you wind down the company. Otherwise, how does the bank award forgiveness to an entity that's been dissolved? But that's more of a legal question.
Yeah, and so there's a distinction with a difference in that, and it's done differently in different states. So there is, in the state of North Carolina, when you say you're dissolving a company, you begin that process by filing a document with the Secretary of State. Whereas in other states like Delaware, there's a filing to begin the process and a filing to end the process, and to verify with the Delaware Secretary of State that you have done everything you need to do, which is gather assets, pay liabilities, report your taxes to the Fed and to the state, etc. So North Carolina has a one-in-time filing, which signifies the beginning of it. So you're supposed to do all those things that relate to to actually terminating the entity, which includes all those things that I just said, which would include addressing the PPP items, because you have to, you'll have to report things on your Fed and state tax returns in relation to the loan and loan forgiveness and things like that. So for me, that's part of the winding down process before termination of the business, but potentially after the filing of the articles of dissolution, if this is in the state of North Carolina.
All right, hopefully that has answered Judy's question. So this is from Felipe. Hey, Felipe, he is a CPA in Puerto Rico. He's enjoyed the discussions. This is awesome. The broadcasting studios from Shoemaker and BGW have reached the island of Puerto Rico. This is awesome.
Yeah, we had the opportunity to do some scuba diving in Rincon probably 3 or 4 years ago. It was one of the best trips we ever took. So I look forward to everything being back, up and running. I don't know the state of how everything's been after the hurricane, but it's a beautiful spot.
Yeah, I've only been to Puerto Rico once for a big anniversary with my wife, and we loved it. So anyway, back to the question from Felipe. I've provided 5 webinars locally about PPP, and your input's been very useful. Now, what are your thoughts on the EIDL package or blanket pledge to those companies that are in process of originating loans for working capital purposes and already have used up PPP and EIDL proceeds?
Can you read that without the first part? Can you read back the question again there, Gary?
Yeah. What are your thoughts on the EIDL blanket pledge for those companies that are in the process of originating loans for working capital purposes and have already used up PPP and EIDL proceeds?
I haven't heard of a blanket pledge. Maybe I'll stall Jack so you can Google it if you haven't heard of it. But I think
what he's referring to, Adam, is the blanket lien that's required by the EIDL to have the priority in the lending. And it sounds like that what Felipe is describing is now we're kind of stuck with the fact that we are going and looking for additional working capital, and we have this priority lien sitting there on top of our heads. And so if that is the question, it's like, okay, I've used my PPP, I've used my EIDL, I'm stuck with this pledge, liability, first position lien, and then I have lenders that are saying, okay, I'm going to give you money, but I need to put my lien and my security interest on the same collateral. So it sounds like one of 2 options, perhaps, that there is some sort of inter-creditor arrangement between, and I don't even know if this is possible with the SBA, because this has not gotten that deep into subordination of EIDL security interests. So a possibility, theoretically, academically, would be an inter-creditor arrangement where potentially the SBA might be able to release a portion of their first priority security interest to give the second lender some priority in some of the collateral. Or, is it that, hey, you go to this second lender and say, I have this EIDL loan obligation. Can I refinance essentially my EIDL obligation? So those are maybe 2 possibilities. But again, I don't know if either of those are possible without prepayment penalties or anything like that with respect to the EIDL loan.
Yeah, I think so now that we're on the same page with what we're talking about, yeah, I think the challenge that you'd run into, obviously you've got somebody sitting in a priority creditor position now, and the traditional lending institution isn't going to want that. But independent of that, just the practical things that we've seen out there is that, man, if you've already burned through PPP, you've already burned through EDL, you better have a really good case as to why you need some more money and have the financials to support it. Because I think what we've seen is that the banks, barring some form of other security interest, which could either be your own personal pledged collateral to back it up, or alternatively, the spigot turned back on and I just, got $1 million in sales that just came in the door that's, brand new today, and I need to go buy, equipment associated with it, or whatever the case may be. I just would think it'd be hard to get the loan in the first place. Like, I know that's a non-answer. It's just that if the client is thinking about, hey man, I'm out of money, now I need to go find another source, let me go to my banking partner, man, our experience has been that tap's shut. There's not a big appetite to extend additional credit beyond what's already been extended. So in this case, I would second Jack's answer, which is, you got 30-year terms. It's really hard to beat, but probably the only way that that a bank is going to take it on will be, to either refinance the lot themselves, or alternatively, and you can't technically use it, I guess, for refinancing. So you'd have to get creative on how you get there. Maybe it's a candidate for the Main Street lending program, depending on the size. So I just, unless you're going alternative sources, in which case they're fine being in a second position. It's probably super sketchy, but my feeling is that if we were to go do UCC searches right now on all the EDL loans, we probably would find them. So, like, I don't know enough about how UCC searches work, but I think the first one filed is the one that wins, not necessarily. Is that a correct statement, Jack?
I'm not getting involved in that. And Gary, can you delete that from the recording, please?
Yeah.
Yeah, that's why we got Jack on here.
Yeah, I always said that I wanted to be an attorney, but it sounds like I'm going to get disbarred before I even have the chance to apply.
Well, you might be the first one to do that, and if you're not first, you're last, according to Ricky Bobby. So,
right.
This is a scenario. Oh yeah, thanks, Felipe. Yeah, we hope to see you in Puerto Rico sometime soon too. This is from Christy. So we've got an employee that's been paid 75% of their salary when we did not have work for him under the PPP. This morning, he informed us that he has a friend working for the Employment Security Commission in unemployment, was advised to apply for unemployment because he would make a little more money. If he chooses to do so, should we place him on layoff so we don't have issues with PPP forgiveness?
Well, I mean, I guess the underlying question is, you've paid the person, are you planning on continuing to pay them or not? So in this case, you would assume that you're not continuing to pay them. So if you were still trying to use your PPP funds because you had some available, and this is still within your window, then in this case, you're going to qualify as, hey, that guy quit and I'm trying to hire him back, but you won't come back because he's getting paid more on unemployment. So I've technically tried to fill the job, but the person wouldn't take it. That's the exception that I think you're going to try to fall under here. Yeah,
and I would say, well, first, Christy, now you're in my David bucket of people trying to stump us. But
yeah,
this employee that has been given this advice has to keep in mind that, I mean, assuming the numbers are accurate, it's, being paid 75%. So does that mean 25% unemployed? I mean, there has to be a legitimate ask of to fill that hole. And it is possible to do partial employment, partial unemployment. But, there would have to be a certification done by the employer, typically for the unemployment benefit. And so there's a lot of hurdles in relation to that. And the other thing too is that every time someone taps into your unemployment, that affects your rate. So, is this employee, not that their loyalty is so great that they're going to say, well, I'm going to, not worry about that 25%, but, is it worth the short-term gain for potentially the long-term pain for you as a business owner, essentially, is a way of looking at it as well. So, but anyway, what Adam said about the numerics and the formulas and makes total sense.
Yeah, I think the other thing that this person needs to realize too is that, the answer is yes, they would make more, but the other part is for how long, because if you just play this thing out, the expanded benefits expire at the end of July. So then they fall back under the normal benefits, which are not, look, it's like the last measure of safety net, not super helpful. I think it's $300 a week, which isn't a whole lot of money to get by on. So, so let's say the guy applies, I'm assuming it's a guy, maybe it's a gal, but let's assume the person applies today. Well, they may or may not get approved like in the next 3 weeks. So I just feel like it's a bad strategy on the employee's part because the likelihood that they'll actually collect anything material in that window of time before the expanded benefits go away, that's just a bad strategy. Because if you just think about, well, what's the other side of that? I apply, I've now quit, you're mad at me, so you're not taking me back. Then I get approved for unemployment, but it's August 5th, and now I'm at $300, and I'm like, oh no, I need to go back to July. I don't think they're doing catch-ups of expanded benefits. So it's maybe if this person would have made this decision back in April, it's a good strategy, but it just seems like a bad strategy at this point. That I would try to, if it's otherwise a good employee, I would really say, well, have you done the math on the difference? Because it's probably only going to be a couple $100 with a whole lot of risk on the other side.
I agree.
Not to mention that, again, so maybe I can get my license back, Jack, on this one. They technically would be breaking the law, I think, when they certify that they can't find work.
Yeah, and with respect to your comment on the license, the fact that most of us get licensed in our 20s, right after law school, after undergrad, a lot of us probably shouldn't be licensed anyway.
We're going to cut that as a snippet, put it up on every social media post.
I resemble that remark.
Yes.
And this next one is from Felipe. It's a statement, and I think we probably covered it in the last diatribe on, but this goes back to the EIDL and the blanket, but it said, I'm really concerned with limitations borrowers might have obtaining new money with this limitation.
Yeah, I think we answered that. That may have come kind of during the conversation as we were having it, but yeah, it's a matter of who's going to lend to someone who's burned, as Adam said, burned through 2 sets of money, is looking for new money, and so there's we mentioned possible ways of getting around that.
Yeah, I think what's going to be interesting, I'm just speculating here, is that so right now, the odds of me obtaining an additional working capital loan, assuming that I burn through all the money, I would say is probably pretty limited unless I've got a really, really, really good case. But what about 2 years from now? Let's just assume for a minute things have returned to normal, and I totally forget about, I don't forget about the fact that I had the CEDA loan because I'm paying it, but I've got this great expansion opportunity and I want to get an increase in my line of credit. I need to, I'm ready to switch banks and obtain a new line of credit or whatever. It's tough to say exactly how this is going to get handled. So, either banks are going to have to come up with a process for dealing with this specific category of loan, or, I think the more likely scenario is that long-term financing is going to become short-term financing, because the bank's they're not going to want to share the assets with anybody. So, and presumably if you think about the EDL loan, the repayment term was dictated. Yeah, thanks, Joe. That's exactly right. Presumably the payment terms were supposed to be predicated based on your ability to repay, but they said 30 years for all my friends. Well, a lot of us can pay that back faster than in 30 years. So I think what will end up happening is that if you need access to credit, you got one of these things hanging out, I'd see it being re-amortized, somehow. That's just me speculating.
Joe, thank you for following instructions and using the chat to harass us and let us know what CPA really means, that says, according to Joe, can't pass again. So I don't know if there's any truth to that, but thank you for weighing in on that. Hey, early on in this broadcast, we talked about the fact that Pinnacle Bank has sent us a note last night that they are accepting applications again. They have opened up the spigot. You do have a application deadline of August the 8th that got moved from June the 30th, thanks to the government. But since we've got about double the amount of people on right now than what we had at the beginning of the broadcast, I just wanted you guys to know that. Brian Red at Pinnacle Bank said that they have opened up the tap again. So any other questions out there? Not seeing any questions. Ron, I think we'll be back on here again, same bat channel, same place next week, next Thursday morning. Robert, another question that just came in. If a business receives PPP and then the business ownership changes before forgiveness is received, does that impact the result?
Well, so we've had, I'm not, in this case, I'm going to assume this isn't just a new shareholder that came on. I'm assuming that this is a change in control somehow. And we've had two clients that have been in this scenario. In one case, it was an asset sale. So the company that obtained the PPP loan just continued in existence, and it's going to be the one that applies for forgiveness. So that's just, completely separated. Buyer didn't assume the liability. In the other case, it's a stock sale. It hadn't closed yet, and it's been going on forever. Sorry about that, Kevin. Maybe it'll close one of these days. But in this case, the buyer's not going to assume the liability, but did buy the stock. So there's going to have to be either forgiveness done ahead of time or some form of indemnification agreement that exists that, hey, if forgiveness is not granted, that the seller is going to be, on the hook for that somehow. Because if I'm a buyer, and I've got some form of working capital calculation, and part of it does not include this PPP cash sitting there, but yet there's still a loan in the books, I'm not going to be okay with that. Those are the only two scenarios that we've seen so far. So if it's the latter, where it's a stock sale or a membership interest sale, whatever, somewhere where liabilities are going to carry along for the ride, man, that's a case where I would rush to get the forgiveness, because I don't see how the transaction is going to close, because I don't see the bank saying, oh, wait, that's great, let me totally help you out, rip up the paperwork, have this borrower, sign a new agreement, because all that stuff got set up with the SBA under original EIN number and a borrower social security number in the first place. That's just going to be hard stuff to change, I would think.
Yeah, and I think also splitting the hair a little bit more finer, that if it's a merger transaction or an asset purchase transaction as well. I think that the business itself, and this is a Jack theory, but I've read a little bit about this, that, if it's a business unit being acquired and the ownership is changed, but it's maintained as a separate division, then, maybe you have additional time to seek the forgiveness. In a merger transaction, when you start merging things together, you have kind of a similar situation where, if you can maintain the integrity of that separate business unit, then you might be okay as far as getting the forgiveness. But, for practically speaking, it's, as Adam said, it's, wait a minute, it's, the lender wants to make sure they get their money, and everything else. So I think it really just depends on the scenario, the nature of the transaction, what it looks like post closing, whether it's a merger or an asset purchase, and being able to demonstrate that you didn't essentially somehow mix and match, that you did keep those columns separately, and maybe that works. Again, I cannot point you to any regulation that says that, but there maybe at some point some guidance with respect to that, because as time goes on, things have happened like closings of transactions. So there has to be some guidance in what to do in those scenarios.
Got another question in here from David. Any update on IRS ruling on taxability?
No. I wish, but no. Other than everybody still says that it shouldn't be taxable, but haven't done anything about it.
Well, if it's true to form on everything else, about 11:59 p.m. on the night before something is supposed to expire, we'll get a ruling from someone.
Of course.
Yeah. I will, on that note though, Gary, I will say one thing. This is something that came up with one of our clients the other day, and it's a larger company. I want to say 60 or 70 employees, some in that range. So they got a decent amount of PPP funding, and it's gone primarily to salary expense to cover commission-based employees that aren't earning commissions because the sales haven't been there to support it. And the challenge you got to put these guys through is you're coming up with salary levels. Like, it sounds like, I don't want to sound like a jerk when I say this, but as an owner of a company, this is the way that I would be thinking. In terms of the balance sheet, if I had $1,000 in my checking account at the beginning of the year, and then I receive $1 million in PPP funds, and I spend $1 million, and assuming that I generated enough sales activity and I didn't do any distributions, loan repayments, all that kind of stuff, and I still landed back with $100,000 in cash at the end of the year, that's actually no good because I've still got a tax liability of $350,000 that needs to come from somewhere. So that basically means that due to this, I'm out of pocket $350,000 from spending all the money. So my point in saying all that is, as we have had people start coming up with cash flow projections about projecting when they're going to exhaust all the funding, that's great. That's more of an expense driven. Part of that's driven by the incoming sales. But as you're starting to think about, well, what are you going to do in the future? Man, until there's a tax law change, you need to be thinking about the liability associated with the fact that $1 million is effectively taxable income if you spend it all. And there's going to be a $350,000 bill associated with it that's going to have to come from somewhere. Now, could I see the IRS doing something like, hey, it won't all be due at once as a special circumstance? Probably, but it's still coming out of your pocket. unless you account for it and figure out how to otherwise generate the cash flow from operating activities to cover it as part of, whether that's, expense reductions or, driving more sales. Somehow you're going to want to try to come up with cash to cover the offsetting taxable income.
Got another question that just popped in here. Okay. Actually, a statement from David. Absolutely. Thanks, guys. Signing out. All right. Thank you for that. The only other thing that I would also say is we're seeing clients, and I just saw another note this morning from one of our clients that has gotten notice from Bank of America that, hey, here's the stuff that you need to be doing to go ahead and get ready for applying for forgiveness, et cetera. And what we've tried to do is provide you guys as much free guidance as possible. I think we sent out something about maybe 5 weeks ago, something like that, or maybe a month ago, about various levels that we can help if somebody wants to go beyond what we've been providing on our website as well as in these webinars. And so if that's the case, feel free to reach out and I can share with you that document that has kind of 3 levels of service. And again, we're not just trying to sell you more stuff. We really want to serve, but some people really want some additional guidance on filling out that application, et cetera. So if you are falling into that category, just feel free to email me at gfrey@trustbgw.com and we'll help you however we can. Any other questions out there before we sign off?
I'll say, I'm surprised, maybe not, that we filled almost the entire hour. So you may want to just go ahead and direct people to that report as of June 30th on the SBA numerics. I mean, there's no reason. I was just going to use that to fill up time if we needed some, but it's on the SBA's website, and it's just the PPP report approvals through June 30th, and it goes through some top line statistics, but then it dives deeper into different areas of the country by services sector, by the NAICS numbers, and even includes some information on 501c3s, diversity of lenders, lender size, the top lenders, top 15, where the money went in states and territories and things like that. So it's just interesting Trivial Pursuit information.
State that again, where that's at, where that can be found, Jack, please.
Yeah, let me, I actually pulled up the PDF. Let me see if I can go back to where it's on the IRS website. So if you go to treasury.gov, and it's a press release that came out on July 6th. And if you scroll down, there is a link that takes you to a PDF that's on their system. And then you can download it to your own computer or your desktop or wherever, or just look at it on the screen.
All right, that's great. Joe, thank you for harassing us in a fun way again. And Adam and Jack, thank you so much. Jack, be safe out there and keep your social distancing out there, and let us know if there's anything that we can do to help you. And in the meantime, we'll plan on being back here, same bat channel, same bat time, 11 a.m. next Thursday. I appreciate what you guys do. And this was by far it's kind of graduate level questions that you guys were dealing with. So good job.
Thank you.
All right, we'll see y'all. Signing off.
All right, see you guys.